Norma Cadena and Shayna Harris.
Good afternoon, almost afternoon. It's so wonderful to see everybody here. This is a pretty meaningful moment for Nora May and I. We met at business school in 2009, but we actually reconnected in 2018 when Nora May was coming through Chicago for World Venture Summit and I was on maternity leave at the time, actually. And that was kind of a big reconnection moment for us. So we're excited to be here. Before we dig into the work that we're doing around impact, we just want to really thank the city of Chicago, and particularly Mayor Lightfoot. So when Supply Chain Capital was launched and we announced 2 years ago, one of the first emails we got was from Mayor Lightfoot and her administration saying, welcome, we're so excited to have you here and we want to support you in any way we can. And since then, they have been a really critical part of our story, particularly Michael, Edmund, and Mark, and we just want to say thank you for everything you've done for us. So we're here today to give you the first kind of sneak peek of our first 2 years in operation and some of the impact we've had as a firm.
So Chicago Venture Summit has a special place in our heart because it was part of connecting the dots to building this firm. We founded Supply Chain Capital in 2020, late 2020, really building on the nearly 20 years we had each spent in the ecosystem working at the intersection of innovation, equity, and sustainability. And we entered because we found a gap investing in the future of food with a lens for climate and really importantly, culture. And over the last 2 years, representing the 16 to 19% of capital in the hands of women as decision makers, and the about 1% of capital in the hands of Latinos as decision makers, and it's okay to boo at those statistics. 16 to 19% in the hands of women, 1% in the hands of Latino decision makers. We've now deployed over $12 million across the food ecosystem. Thank you. We've raised a $40 million inaugural fund. We're backed and supported by strategics, funds of funds, family offices, individuals, and the Illinois State Treasury. So thank you, Illinois Growth and Innovation Fund. And our inaugural impact report is really meant to review, audit, and capture our impact work to date. We really wanted everyone to understand how supply chain is walking the talk around not only investing with a returns first mindset, but also thinking heavily about impact. And we can go on, okay. Now our firm looks for impact across 3 dimensions: culture, health, and the environment. And we took a snapshot in 2020, and 77%, so over 3/4 of our portfolio is led by women and/or people of color. About 70% of our portfolio impacts human health positively, and about 70% of our portfolio reduces or reverses the food system impact on climate and the environment. If you were to take a snapshot today, 60% of our portfolio companies are led by women as CEOs.
Yes, clap to that. We want to give you a sense of our impact right here in Chicago. So I'll ask if any of our Chicago portfolio founders are here, please stand. And we'll tell you a little bit about these amazing founders. Woohoo! Excited to see you here today. So 40% of our businesses are headquartered here in Chicago. And these are companies focused on the future of food and technology. So 2/3 of this portfolio is focused on health and focused on the environment. Cadea is reimagining the supply chain for plastic water bottles using technology. IO Foods is creating a national platform for West African food and flavors. Hi-Fe Foods is repurposing the food supply chain wastewater into climate positive goods. Food Ready is a food safety software critical for building a safe infrastructure for food nationwide. Aquacultured Foods, fermentation-based seafood alternative, and 99 Counties is a marketplace for regeneratively cultivated meats right here in the Midwest. We are so proud of these companies and their impact, and in a month we will actually be releasing our first impact report. What's really critical about this report is not just who we've started to invest in, but the way we as Supply Chain Capital have started to operationalize a theory of change metrics, and measurements to report on our portfolio's progress over time. We will get that report into all of your hands, and we are extending an open invitation to help any of your firms as you're starting to think about your impact journey and how do you actually operationalize this and make it real. In addition, we want to extend an invitation to anyone here in the audience today from strategics, corporates, and others who want to partner with us, support these phenomenal founders, and be a part of history. So thank you so much. I have the distinct honor to introduce our next panel, which is about the future of markets. So how many of you have gotten some funny feelings in your stomach over the last couple of months with everything happening in the markets? It's been on all of our minds. And, there's been a lot of doomsday talk, but many of us in the finance industry are actually talking about what lessons we can learn from the past and actually what's different about today's market environment. So we're going to be speaking with our three distinguished guests about this on today's panel. We have Lori Bauer. Lori is one of the founding partners of Cooley Chicago. So many of you in the food scene know her. They are about to celebrate their 2-year anniversary, and we're really proud to have Cooley as a part of the ecosystem. The amazing thing about Lori is she's been practicing law for over 2 decades. She's done many deals in the food and ag space, and she can talk to us about what the last market cycle was like from her purview as an attorney. Juliana Medina is a managing director emeritus from JP Morgan, where she led investments in food, agriculture, tech, and consumer, including the Jose Cuervo IPO, so she can talk to us about that. And in 2008, she was an investment banker in Colombia, so also has very extensive experience. And Sarah Foley is an investor joining us from SWAT Equity Partners in New York. SWAT Equity Partners has a long-standing investment track record in the consumer tech industries, and Sarah was in private equity in 2008. One of her most recent exciting investments is in Banza, which is a brand we all love. So I just share a little bit of these women's backgrounds because they have legitimate experience, they know what they're talking about, and they're going to help us understand markets. So we're going to start with Lori. And Lori, we want to understand a bit more of the historical perspective, what you saw in the past and kind of what's happening in today's markets and what's different.
Yeah, glad to speak about that. But first, just also thrilled to be here. As you said, we're almost at our 2-year anniversary of opening in Chicago, and it's been a wonderful 2 years, thanks in part to this wonderful community. So thank you so much for the warm welcome for Cooley. But yes, looking at the current market and thinking retrospectively about it, we certainly talk about this a lot at Cooley because what we do is represent both founders and investors that are looking to raise capital all the way from seed stage through growth equity, through hopefully an IPO exit or M&A. And so we have lots of discussions around that, including how can we draw parallels or make distinctions from prior experiences. And so one of the things that we talk about a lot, especially with first-time founders or people who maybe raised for the first time in the last 2 years is, look, that was really at a peak, right? And markets are cyclical, and so if you sort of look at deal volumes, amount raised, pre-money valuations, depends on where you're at in terms of a seed versus a Series C. But this is not uncharted territory, right? We're more, especially for early stage companies, we're more like 2020. It's not, so if you look at, what valuations were 18 months ago, of course it has fallen off, but the market is cyclical and it's sort of going, in the past, if you look, it's gone like that. That's what, if you look back to the 2000, 2001 dot-com bubble and how that burst and, sort of companies that came back that had good fundamentals, the investors were still looking to invest in them. Same thing in 2008, there was a peak and coming out of that, good companies were still getting funded. And so, it's really hard to say where we are on that cycle, but I think it's also important to put this cycle in perspective.
So Lori, just a quick follow-up on that. What do you tell your clients when they come to you and say, I'm worried? I'm worried about the capital environment.
Yeah, I think it depends, right? So there's a lot of strategies that we're seeing companies deploy, and of course it depends on where you're at in terms of what your cash runway is. But I think it's, first, understand what your runway is, figure out how to conserve it or preserve runway, whether that is managing expenses, or maybe looking at alternative ways to raise. If you think you're going to go raise 20 million, maybe say, well, maybe I can't get the valuation that I want, so maybe it's a bridge or something else, and understanding what the different sources of capital that there are. So it kind of depends, but I think it's just not to panic and to try to stay organized in terms of how you think about what your cash needs are and what the alternatives are.
Okay. So a question that founders are wondering about, I know many of you in the room, and investors are asking themselves is, should we be deploying right now? And you'll get varied answers depending on who you're talking to. Juliana lived through the last cycle and saw winners and losers based on who was deploying. So what should investors be thinking about this question of should we deploy?
Look, we now have the benefit of 15 years of history past the previous down cycle. And what you can see from the numbers from what happened is that people that were investing during the downturn, that continue to do M&A, that continue to look at their portfolios strategically and both do acquisitions, maybe smaller acquisitions, maybe not the huge deal, but smaller size, or some reshaping of their portfolios. Those players were able to capture significantly higher returns than the ones that stayed on the sidelines. And this was mostly because they have already set up kind of engines of M&A and growth, and that's embedded in their culture, and they were able to continue with this. One example there, for instance, if we think of the food industry, is General Mills. They have been consistent. They, like from 2007 until today, I think there's only been 1 year when they didn't make a relevant acquisition. They started looking throughout the tough period. They look outside. They did an acquisition in Brazil. They consolidated some of their portfolio in France, in Southeast Asia. And that kind of gave them runway to continue doing, and then the big deals that they continue. And if you see, they've been trading multiple wise above their peers. They had significantly higher return. So that's just one example in the universe, but the message is, even if it feels kind of scary to think of deploying capital in the tough economic backdrop, it is a good, it has proven to be a good strategy.
Yeah. You know, founders have come to us saying they're a little bit confused, right? Because they're hearing there's all this dry powder out there, but I can't access any of it. And we talked a bit about this as we were preparing for this conversation. Sarah, you had some interesting thoughts on what you've been telling your founders and just what you've been seeing in terms of the fundraising environment.
That's right, and happy to be here. I'm happy to be back in the Midwest where I'm from. So for me, this is a real treat, and to see so many people, it's fantastic. We've been chatting with our portfolio. It's largely a collection of consumer brands. Food is certainly a big category of them, and telling them to start to slow the roll a little bit. And what I mean by that is start dialing back on the kind of growth pace you may have been chasing, and probably at a less than efficient kind of capital deployment ratio, meaning are you spending too much, not getting that return on whether paid acquisition is your primary channel or it's promotions on the shelf. Slow down the roll, slow down your growth a little bit in order to, Julie's point, extend the runway. Let's figure out how you find some option value in having more control over your destiny by not having to go back to market maybe as quickly as you might have thought you needed to a year ago. Can you extend that 6 months? Can you extend your current cash position through 2024 by right-sizing your expense structure? Maybe you're not hiring as many people. We have had those conversations really starting in the summer of last year. That doesn't mean that everybody in our portfolio listened to our thoughts and our suggestions, having been around a couple of these downturns myself. But those who have made difficult decisions. They've had to let some people go. They've had to really start slowing their e-commerce growth as their kind of return on that ad spend just isn't where they want it to be. So let's go figure out other options for where to deploy some of your marketing spend in channels that are going to be a little bit more efficient.
Sarah, what brings up a feeling in the pit of your stomach, like I've been there, done that in the last downturns or during last cycles, and what's different today?
So I think what's different in this particular slowdown is we've got two things happening we didn't really have in that global financial crisis in 08-09. One of them is inflation. And we didn't have kind of the supply chain problem that the pandemic has produced going into this slowdown in that period of time. And that is a real crunch. Companies at the size that we start to invest in that are seed to Series A don't have pricing power, right? They don't have the ability to go out to a big grocery chain and say, hey, we need to take a 10% price increase. That chain's going to say, that's cute. We're going to take this other General Mills product portfolio and put it back on the shelf because we're just not sure that our customers are going to see the value proposition you're asking for yet. So that's a problem. We've seen in our food portfolio margins really at the gross margin level almost kind of constrict by half. So going from mid-40s to the mid-20s. And that doesn't give you much of an umbrella to work from underneath in order to start spending where you'd like to on both team and kind of general marketing costs to build your brand and build more distribution. So that's one big change. The other, obviously, is we've been in a low to no interest rate environment for 14 years. That's something that is also kind of putting more capital kind of constraints around access. There is a lot of capital on the sideline. Investors have a lot of capital to deploy, but the visibility factor I think they're working through at the moment is cloudy enough where they can take 6 months off to really try to evaluate, given their various investment strategies and sectors they're focused on, what's happening. Wait until this reset on valuation expectations has settled further in order to find investor and kind of company closer to working and operating off of the same page. So interest rates and inflation are the factors I think that are more prominent and front-facing in this particular slowdown than we had previously.
Yeah, and I would add just a point to your last point on valuation. It's like, if you think of the previous recession, like valuation was coming up and deal volume and everything like pretty quickly, right? It was like this. Here we've been at a level where we've had 5, 6, 7 years of very high valuation, so it feels like the drop is significant and we're really changing the normal, but most likely we're just going to a normal level of valuation that people just don't remember because we've been in a really bullish period, longer period than before. So it feels very different, but it might be time to adjust expectations.
And I think you've got to make sure that at the earlier stage you may be in growing your business, if you're raising rounds at too high a valuation today, raising that next round and trying to get it proportionately higher again is difficult. Those optics are not really, they're no longer kind of a wish list item, they're real. And we're going to see flat, reopen round, obviously down round, but I also think we're gonna see a lot more insider-led rounds kind of putting their arms around portfolio companies in order to give them a bridge to 2024, 2025. And they may punt around what that looks like in terms of valuation. Could be a safe note, could be convertible notes, but I think that's going to be, it's already happening. I think that's going to continue happening for a lot of this year. Did you have anything to add?
Yeah, no, I agree with all of that, especially in terms of what we've been seeing. That's exactly what we've been seeing. We track in terms of the deals that we do. It's not that there are no deals happening. It may feel like that, and like Series C and Series D and beyond, that market is really, really tough. But for for Series Seed and Series A deals, it's fewer, but they're still happening, and I think that is a distinction that you can draw from. I was chatting with one of my senior partners about looking back to the 2000-2001, and the point there was like there were no deals because that was based on the tech sector, and people were just like, we're not investing in that. I don't think we're seeing that. Investors are not saying we've given up or we're pulling back, but let's wait and let's look at the fundamentals of companies. Let's be a little more cautious. Let's think about the valuation. Let's maybe invest a little bit less, but it is still happening. And so we are seeing a lot of rounds where current investors are stepping up and, we are hearing a little bit about, a pay-to-play maybe, things like that, but those are, insiders saying, we're gonna continue to support this company, and hopefully everybody will come along. But it's not the terrible draconian terms. I think people are still feeling optimistic about the future. It's just a little bit of a pulling back, especially at the higher dollar values.
It's needed. I mean, to be honest, this is a little bit of a Darwinian comment, but we were at peak, and that peak was not justified by fundamentals whatsoever, both in the private markets, I think, and in the public markets. And you're seeing the correction come through on the public markets, which we all can look at every day, still happening in some sectors. And the private markets always lag a little bit. So it's been about a year kind of from the tech start of the downward kind of draft. I'm starting to see it, at least in my pocket of more consumer-oriented brands now. But at the seed stage, that valuation decrease isn't massive because the rule of numbers is you can't go down from 10 to 5 as easily as you can go down from 150 to maybe 75. So a different way of a silver lining could be if you're earlier in the building and scaling of your business, raising that seed to Series A stage, there's still plenty of activity.
Yeah. So a question on that. So investing in food is a lot of things. I think for folks that aren't familiar with the sector, they often think investing in food is just investing in a product, a consumer product, right? Investing in food is investing from farm to fork in distribution, logistics, software, marketplace, products, deep tech, SynBio. It's a lot of things. Are you seeing differences in the types of deals you're seeing come across your plate in terms of the specific sectors? Like, is there a sector that's stronger than others, a sector that seems to be resilient or emerging, or one that's being mostly impacted? I'm wondering kind of what differences you're seeing. Maybe the types of deals you're seeing come across your plate because you work on a lot of different sectors.
Yeah.
Yeah.
Yeah, I think it's, I think being in the food and egg tech space is a really exciting place to be. When you think about what companies, new sectors spun out of 2008, right? Like fintech, like some of the newer areas that we think of today didn't exist, and I think that food tech, egg tech, clean tech, all these things that are focusing on how are we going to feed the planet while not destroying the planet, maybe another way of saying it, were not things that people were thinking about, but those are things that are very front of mind for people now. And so if you have a company or a problem that you're trying to solve that's important to funds that have raised money on that premise, I think there's a really, really good fit because there is powder available. There are funds that have been raised that have a specific type of mandate. And, we see, when I've talked to some clients, I've said, well, hey, do you think you fit into this investor's mandate? If you do, maybe you should change your slides to highlight the things that they have told their LPs, because some funds that have raised for these specific purposes have told their LPs that they're only going to invest in companies that are reducing carbon or that are doing X or Y, and maybe that's not your fundamental or why you've come out with a different way of producing food, but maybe it fits within that, and now all of a sudden that's an investor for you, and they have a mandate and they do have the ability to invest. So I think being in the food sector at this time is a really great advantage, just given the amount of interest that there is in investing and supporting new and better ways of producing it.
It's interesting, and following up, kind of thinking about this, is this an IPO environment? Is this an M&A environment? I mean, Juliana, you oversaw some pretty high-level, incredible deals at JP Morgan for over a decade. Yeah. What's the exit environment like right now?
Look, I would think just given where the markets are that are cold, the IPO environment is very hard. Getting valuations in the IPO market, even getting investors to go through, it's going to be tough. But it's a good M&A environment. Yes, valuations are going to be tighter. If you think from corporates acquiring these or financial investors, diligence are going to be harder. But what I think this type of backdrop brings is different structures. For instance, I would think a lot more of stock deals rather than cash deals would be supportive, because then valuations become relative. Then, my 3 eggs are worth your fourth, and that's a different mindset, even for the founders, to start thinking of where we go next. And in some cases, it gives you some leeway to explain better the business because there's less competition. So it's not around of who's paying the price, but who's actually seeing what my business is about. And that gives you better partners for an M&A exit. I would say it more like that.
It's certainly more of a buyer's market.
Yeah.
You know, we call it investor friendly, thankfully, finally. But that just means that, again, this level setting, which is needed, is happening. I don't think we're all the way through it, quite frankly, but we're closer. Great companies with great KPIs are always going to attract capital and kind of be in the driver's seat. There just aren't that many of them. There's a lot of capital, as we've talked about, trying to chase them. So they're going to have a pretty good time, even in a difficult market, raising capital. But they're not the only ones that are going to make the ecosystem continue to move. So the rest of the world and the rest of these companies that are out there are certainly going to find their niche. And it just takes one investor to say yes, to get the ball rolling. And just please keep that in mind. While you may feel like you're only getting no's out there, we feel it too as we're raising capital on the GP side, believe me. But you just need the one, and then you get another, and then you start to build that kind of investor community in your cap stack, which is really important. But it's a buyer's market. These are, as you said earlier, the best times to be building kind of our portfolios. They're great times for corporate M&A activity. Earn-out structures, I think, is another way to play, kind of figuring out how to make something happen in this environment. So we don't want you to come away thinking it's all doom and gloom, as we talked about on our prep session. There are lots of silver linings, but you've got to be very thoughtful, I think, about your approach.
And while it feels like there are no deals, deals are happening.
Yeah.
I mean, I think volume, at least on the M&A side, has come down like 15%. Valuation has come down like 40% compared to last year. But deals are happening. It's just a different pace and a different type of deals.
Yeah, and I think if you're a founder thinking about how much should I raise, or I really wish I could have raised more, I think maybe it's pausing and saying, well, how much do I actually need to raise at this stage? Because we actually were talking about the M&A market globally at one of our meetings yesterday, and exactly right, like buyers are not going to pay as much, but if you've only raised 10 million and someone makes an offer to buy your company for 50 million, that's a much different deal than if you raised 50 million, right? And so if you think about doing what you actually need, it gives you more optionality if you're the amount of capital that you have to repay, and if you want to have a return to the common as well. So there are even more silver linings, I think, about to raising less money. It brings a little more discipline, which, Sarah, to your point, I think some folks think was needed when capital was a lot easier to raise. So I think it's just sort of a more disciplined and traditional market.
One thing we talked about as we were thinking about this panel and how we could be helpful to the audience is thinking about like the anatomy of a deal and kind of what's behind that, demystifying a little bit. And Juliana, you brought up an example, and I'm wondering if you could share. You talked about the Jose Cuervo IPO. Just demystify a little bit what that deal process is like.
Well, and this is for an IPO, yeah. So in this case, I mean, I think especially, and while Jose Cuervo in this case is a huge company and everything, it was managed, family owned, managed by one person basically, which relates, when you're the founder, that's your business, that's your legacy, whatever, if even it's 100 years or 10 that you've been working at it. And I think the whole process is really understanding what are the main reasons of why you want an IPO. Is this a deal where you need to get investors out? That's one mindset. Is this a deal that you need succession? You need to professionalize the management team. Is this just fairly a cash exit, right? So it depends on that. And from there, it's really just when you end up pitching your deal, you're doing exactly the same that you're doing when you were starting. And for investors at this level where you're IPOing, which is more institutional investors, larger, mindset, it's the same thing. They gotta get in love with your deal. They gotta be in love with your company. They gotta understand that you're not gonna just drop the ball and nothing's gonna happen with the company, but there's a clear growth path. There's a clear market understanding. There's a clear scalability. Those continue to be the drivers in any, IPO deal, especially in this sector, when you're thinking, okay, what's your end game? How do we make sure that this platform doesn't just become, a dying exercise that no one's going to be looking at? Because what you need also once you're public is you need analyst coverage, you need interest from investors to continue rolling the ball, you need retail investors to be interested in your company. So the whole selling and being in love with the business needs to continue to be kind of the key element for a successful exit.
And how should founders who are just starting out, because there's a lot of early stage founders here, be thinking about exit? Because that could feel daunting when you're at the very beginning of your journey and trying to keep the lights on and send your software, get your product out. What should they be thinking about now? Like, how do you talk to founders about
I know
this?
it's such a strange kind of question to ask during a diligence process for an early stage company on, so what's your exit plan? It doesn't feel like it makes sense, and it's way too far in the future. But what I look for when I do get around to that question is I'm more interested in how the team and or the founders are thinking about the opportunities around exit. If they're solely focused on a moonshot with an IPO exit, that puts me in one particular camp. Again, my focus is around consumer brands, and exit through an IPO is the last thing that I would expect to happen. I'm more interested in what they're thinking 5 years down the road with respect to how is their product roadmap extending, how is their distribution strategy moving along and expanding, and where are they focusing their kind of financial metrics? What are they thinking about with respect to their path to profitability? Mm-hmm. That's always been important. The chase on revenue is a phenomenon that's well over. You've got to have an idea of when you'll get to scale where you can break even and then start to grow. And when you're in that position, the options you have around next round of capital that leads to an IPO, a corporate, or even a private equity stop or two along the way, you're just in the driver's seat. Mm-hmm. So don't underestimate, and please underscore, you've got to show me how you're going to find profitability.
Mm-hmm. And it also showcases that you understand the market you're playing in.
Yeah.
If you have no idea what's going to be your exit strategy, what's going to be, if there are possibilities of M&A, you're really just trying to get that Hail Mary IPO that's going to happen at some point because you're going to have to exit, like your investors want to exit. So really understanding the landscape, really understanding where your new product, your new technology connects with the bigger trends, with the bigger corporate world, that's important. That shows me that you actually understand where you land in the entire ecosystem.
So open up the next question. This is a perfect lead-in on trends. We've seen shifts in the macro environment due to COVID and the pandemic, and some things stuck and some things feel like they went, the other way. So D2C spiked, and now we're back in retail. But we're also seeing policy impact our space, thinking about climate, Scope 3 emissions, the president's mandate on biotech, which is opening up all sorts of innovation in food. What are some of the trends that you're either excited about or you're just seeing an acceleration of deals around these certain trends? And I know that, Cooley's been thinking a bit about biotech and life sciences, but just curious generally, like what types of deals are you seeing? Are there more of a certain type popping up because of these macroeconomic trends?
I think when you're in a space that is trying to do good as at the same time that you're trying to do well, I think that there are a lot of government. There are ways in which government policy, and by way of tax credits as well. We have some companies in the clean energy space that are really positioning themselves for how to take advantage of those things. I think that, so we're definitely seeing companies pay attention to those types of motivators. I think in terms of the core fundamentals, though, I think it's always really important to stay focused on what's the value proposition, and hopefully that can give you a little boost. But if you always have to think about what if that goes away, is my company still profitable? What if the tides change? So I definitely think that it's important to pay attention to where investors are and where the political climate is pushing things, but to still stay focused on the fundamentals of can you profitably solve the problem that you're looking to solve.
Yeah. I'm excited. I mean, I think the whole plant-based speech, I am excited about it, less from the consumer demand and more from the food availability, a climate impact that it may have. I think we're still years away from really having a scalable business there, but that's one of the trends that I think it's going to be relevant if we can address it and can go through it from food availability. And I think you guys are in the midst of it.
Yeah, absolutely.
Again, kind of with my consumer lens hat on, we think a lot about, and my great colleagues here just published a fantastic newsletter that we did, wellness, proactive wellness with a dash, I would say, of kind of sustainability. So could be more plant-based oriented food, could be all cleaner, better, lower kind of to no processed food. Could be eco-friendly packaging, could be recycled packaging, but that's where we are spending more of our time on both physical kind of fitness and certainly nutrition, wellness, and what are we doing to more proactively manage our health as a result, largely of kind of coming out of this massive health scare called COVID. Mm-hmm. But we're also trying to extend that into what does it mean around financial wellness? What does it mean for relationship wellness? What does it mean around other mental wellness areas too? So proactive wellness, again, with that dash of eco-consciousness, I think is important. Keeping that value proposition front and center.
I love it. So I can't believe we're almost out of time. We wanted to end on a fun note, and Mayor Lightfoot this morning talked about what a fantastic food city Chicago is. We agree. So Lori, what's your advice? This Lori, not Mayor Lightfoot. Lori Bauer, what is your advice for Juliana and Sarah about kind of must-eat food experience in Chicago?
Well, where I'm at as a suburban mom, I spend a lot of time at Portillo's, which they have it out in the burbs and they have it downtown. So if you want a true Chicago experience, I think of that. Any sort of pizza place, all the way from the very famous mainstays to, again, in the burbs, there are other pizza joints. But I would say explore all of that. I mean, we have a wonderful restaurant in our building, Bar Mar. It's a Jose Andres restaurant. So I think get out there and experiment. There's just so many great restaurants. But Shana, maybe I'll throw it back to you since you're more looped into it.
Well, I grew up here, and so I just think back to my childhood. So I'd say for deep dish pizza, Pequod's, you know. And if you're in the suburbs, for thin crust, Barnaby's with the cornmeal crust.
Yes.
That would be my recommendation. Well, thank you so much for sharing your wisdom with us. Appreciate it.
Thank you.
Thank you.
Thank you so much, Shana. And ladies, let's give these ladies another round of applause for that riveting discussion.